All right. So everyone, this was as last second as it could be. I literally called these guys around 2 o'clock, like, "Hey, what would you think about doing something around 8 o'clock?" And Phil was like, "Whatever." Nick was like, "Yeah, cool, let's do it." But what is it? Nick was actually a little bit more practical about this than I was,
More
but
thoughtful. He's usually more thoughtful
much
about
more
just about
thoughtful
everything in life. So take that into consideration when
as we go
reviewing our
through.
comments.
As we
My
go
only
through
compliment tonight, Phil, right?
I mean, the night's young. We'll see. We'll
the
see what
night.
you have to say. See if you say anything smart or not.
So we're gonna go. I got this budgeted for an hour. It could go a little shorter, could go a little longer, depends on how into it we get. But the whole point of this was, with all of the news right now out there with this coronavirus, COVID-19, whatever the heck it's called, we all understand the impact, and this call is not at all to look past the impact on folks that are physically afflicted with the virus, folks that are close to or familiarly related to folks that have potentially passed because of the virus. I mean, there's plenty of bad in that regard. And then economically, of course, we're privileged to be talking about the impact on our real estate businesses when some people are just wondering how they're going to get the hours together to pay for what they do day to day. So all of that is not lost, and there are probably things over the next week or two that I'm going to try to put out there for us to help. One of our with multifamily and more, one of our guiding principles is to give more. So if there's a way that we can help contribute, we're going to do that. But what this tonight is about is, as real estate investors, what's the potential impact here? So I brought these two guys in. I'm Jamie Gruber, by the way. If you don't know who I am, I'm the founder of the Multifamily and More Group. We have 15, 16, 17 different chapters around the country. And you probably found this through one of those chapters. So thank you for being on tonight. And I want to make sure this adds tremendous value to all of you. These two guys, they'll introduce themselves in a second, are two friends of mine that I get the privilege of hanging out every Monday night with, along with a couple other guys. And we talk about, our goals, holding each other accountable to them, so on and so forth. And they run different real estate businesses and probably encapsulate what most of you are running right now in one way or the other. So I thought it would be good to get each of them on for their perspectives on their businesses. And we'll walk through, after they introduce themselves, kind of two different sections. We're going to talk about the impact, and then we're going to talk about some mitigation strategies that they have in place or that they're thinking about that hopefully help all of you if you haven't maybe thought of some of these, or if you have started to think of them but aren't quite sure what the next steps might be. That said, I'd like for this to be a discussion, so please feel free to drop in the chat box any thoughts you have. And if I have one request tonight, it would be simply that if you have to leave, or if you leave, whether it's at the very end or somewhere in the middle, just do a checkout for me. Just drop in the chat like something quick that you took away from tonight. It helps me to know how valuable this was. And if you wanted to go an extra step, you could take that and paste it into a Facebook post. Great, but if not, at least I have that, and I have an idea of what kind of value you took away from this evening. So, with all of that said, I want to introduce our two panelists. So I think we have to go with hairiest first. I think that's a rule. Yeah.
Definitely a rule.
So Phil, why don't you tell us a little bit about who you are, what you do real quick?
What's up, Facebook world? Phil Capron, operating in coastal Virginia. So that's Virginia Beach, Norfolk, Chesapeake, and all the way up to Richmond is where I do my business. Mostly a large multifamily guy, but I cut my teeth selling residential real estate, buying, holding, flipping, and then small apartments on the big apartments. So that's my background, just for reference.
Nice. All right. Nick.
Nick Spade. I'm in the Allentown, Pennsylvania market. I own a bunch of small multifamilies and single family homes, anything up to basically our base one's a 22 unit. We have about 80 units. We're looking to buy another 20 this year. And former teacher. I have an 8-month-old daughter and an awesome wife named Kayla.
Yeah, you do. All right, cool. So we've got a guy who's diving into the multifamily side, and Phil has syndicated deals. He's kind of done it all in multifamily, and continues to. And a guy who's dealing more with the single family and small multifamily portfolio, as well as a property management company. So two different perspectives on this. So why don't we go down and talk about, let's call it like this, like we'll call it, I think you can make it an acronym like SWOT, like strengths, weaknesses, opportunities, and threats to your individual businesses. And we could start with Nick. So what are the strengths, weaknesses, opportunities, and threats with this whole coronavirus pandemic to your business that you've thought through. We can get, go as deep as you want. And again, for those who are watching, if you could comment, ask questions, these guys are here to answer them. And please just change from all panelists to everyone so we can all see what your questions are. And these guys would be happy to chime in on their thoughts, and I'll pop in if I feel like I have something somewhat intelligent to say. But Nick, why don't you go ahead and tell us, what are you seeing? Strengths, weaknesses, opportunities, threats, whatever order you want to take it, but give us some perspective on this from your side.
So there's a lot of unknowns right now coming into the pandemic that we have. I don't know exactly what's going on. I'm not going to claim that I do. The thing that I'm most worried about is keeping food on the table and also making sure my tenants are paying on time so that everything can run correctly.
Yeah.
For strengths, I would say we have a family-run entrepreneurial business where if I had to, I could ramp down how much we pay each person to basic levels. We know everything construction-wise, so if something needs to get done, we don't have to pay for it. If we have to use subs, we can avoid that. I think there's a lot of opportunities right now for expansion, and we have cash out finances coming through that are going to allow us to take advantage of market opportunities. I also think one of our strengths is that we have a diverse portfolio between the B+ and C markets, where we have some tenants that are working, some SSI disability income, some are Section 8. So when income and property locations are going to come into play with the possible challenges that come forward, we have different ways of our tenants paying. So HUD's not going to stop paying. Disability checks and SSI are still going to come through. Do you want to go strengths each and then knock it down?
Yeah, we can do that. Phil, what about you? What strengths do you see in your business? Because you mentioned, Nick, expansion. I want to dive in more on that when we get a second. But go ahead, Phil. What are strengths that you see on the multifamily side, larger multifamily side?
Okay, so Nick enjoys, and this isn't a competition or a debate, just to frame that. It's not,
Remember, we talk every Monday, literally. So this is very familiar.
We debate
every Monday.
This is not that. So Nick, I'll give you another compliment to start off the evening. Your business, it mimics mine. You guys have a certain economy of scale with how many units? I forget exactly how many.
82 right now. Exactly.
So you essentially have an apartment building. It's just spread out. So I'd say a strength of my business with 350 apartments is that certainly we're in for some troubled waters ahead. But for those out there that have one single family or a quad or a duplex or whatever, and that's it, when yours goes down, it's 100% down. When mine goes down, maybe I lose 30 or 40%. And as we kind of evolve in this conversation, we'll see what that looks like from a few different standpoints. I'm never going to have zero. And if I do, we have larger problems than my building's not producing income.
Sure.
So I'd say that's a strength of the larger multifamily. That, and also, Nick runs a family-owned business, and that is a strength in itself. As far as quality control and influence, I'm going to consider the fact that I have large professional third-party property managers working on my behalf as a strength. The ability that they have to leverage contractors, managers. If one leasing agent doesn't come in, they've got 3 others that can replace them, billing, stuff like that. It's a lot of stuff that could get a little complex in the coming months that I don't necessarily have to deal with personally, that I take a 10,000 foot view and provide direction to them who are on the ground. So I'd say that those are 2 strengths of my business.
Okay. All right. So let's flip it the other way. Phil, why don't you start with where you see weaknesses, and then we'll go down to Nick and talk about his.
Okay. So, weaknesses and threats. Like, I'm having a hard time differentiating the 2.
Yeah, it is tough. So just bring it together.
Yeah, I'm gonna meander as I often do. So you'll see a lot of people on Facebook that are talking about the great debt that we're about to all get, right? Oh, the Fed cut rates again, so we're going to get all these great loans. Not necessarily. What I've already seen over the past month is that banks and institutions are widening what's called their spread. Most banks are lending at, like the 10-year treasury, and you could look online to see what that is right now. It's probably going to be about a quarter for the 10-year, quarter percent down from like 0.75% a week or two ago, when they did their last cut. So they would do the quarter percent plus, call it 250 basis points, or in layman's terms, 2.5%, for a rate of 2.75% to you. But the banks are realizing, hey, this is not good. This is, we're giving too good of a deal to these investors or the consumers, and they're increasing their margin. So even though they might be getting the money from the Fed or the ability to lend it at a quarter percent, they might now want 300 basis points, aka 3%, or 325 basis points to kind of kneecap us at 3.25 or 3.5. Don't get me wrong; those are still fantastic rates, but everyone that is basically thinking that the spreads from a month or 2 months or 6 months ago are going to continue in existence, I'm going to let you know they're not. I was just negotiating with a lender on a 92 unit I have under contract on Friday, Thursday, Friday, and there were 305 point spreads, where a month ago it was like 255 or something like that. So,
Hey, Phil, do you see this specific to the commercial market, or do you see this across both? Maybe Nick, you can weigh in on that.
So there's indication. Everyone thinks that on the residential side for owner occupied stuff, it's going to actually mimic what the Fed is doing a little more closely, which would provide, fantastic opportunities for single family purchasers, owner occupant purchasers. Is that going to extend to investor mortgages? It's just too soon. We don't really know. So everyone that's getting all excited, like it's going to be the best ever, I'm not positive. Like,
Nick, do you think anything on that from a single family investor standpoint?
I think residential owner occupants are going to go down to around 3%. I don't think that we're going to get very much lower from a commercial standpoint. Even in 2009, 2010 area, they were still at 4.25. I didn't see much below that. And I'm working with kind of localized solid lenders that give us really good deals. So if it does, a quarter point here or there, half a point, even sometimes a full point, I don't really care. I'm more concerned about how long the rate is, what kind of amortization schedules it looks like, how long they're holding it. Is it a balloon in 5 years or 7, or do I get it for 14? So my typical loan is 7-year fixed, 14-year term, and then it's amortized over 25 years. So I have 14 years essentially with the same bank. The interest rate, quarter point here or there, commercial side, I don't think it's going to really impact me.
Okay. So continue on.
I have some loans at like 5.5 that I am going to be looking at what to do, but that's kind of 2 months from now.
Why 2 months from now?
There's other things going on. So I just think that's going to be more of my timeline. So we're in a 1031 exchange right now where we're selling a house, buying 9 more units that we're negotiating on right now.
Understood. Okay. So, nothing specific to this whole pandemic. You're just saying it.
No, interest rates are always going to be low. I don't think that we're going to get out of that for another couple of years. So the excitement is more of the quantitative easing that's happening again and lowering this. It's just going to bring inflation and increase asset values. So basically the same stuff that's already happened.
Yeah, makes sense. All right, why don't you continue on, Nick? Weaknesses, threats, whatever you want to do. What do you see as those for your business? And we'll flip back and forth on this.
So weaknesses, I looked at this as a day-to-day operation where are my weaknesses when I want to close the office, and what can I do more efficiently? So I'd still do some bank runs with one of the banks we work with, and I can deposit checks online. So I looked at how to do that and actually set that up. So that already saves me about 2 hours a week. Not everything I have online right now for rent collection. So yesterday I ordered a Dropbox, which I was trying to avoid, but it seems inevitable right now for money orders for tenants. We manage another 30 units on top of the 80 that we own. So there's, I'd say 60% pay online. So there's another 45, 50 people that come into the office, but now we obviously want to avoid contact as much as we can, social distancing and all that. There's also other opportunities, saving time with technology with work orders instead of just calling me, so I can streamline those processes. Yeah. So it's helped me look at the business as a whole, to use that and make good decisions to eliminate those weaknesses.
Makes sense. Okay. All right. What's a threat that you're concerned with right now?
Economic vacancy is the biggest one. What happens with schools out in Pennsylvania right now with families that have to watch their kids? And we're definitely going to see that probably some in April, but more in May. So they're going to get paid their second paycheck right now for this month because it'll be backlogged 2 weeks of their work.
Mm-hmm.
But then in May is going to be the true timeline for that. That's my biggest concern, but we're just going to have to see how it plays out.
Okay. And we'll talk about some mitigation stuff. I know you have a really interesting story about how you structured your business around the 29 crash. We'll get into that here in a little bit. Phil, what about you? You kind of touched on a little bit. Any other threats that you see to your business on the multifamily side, large multifamily side?
Yeah, real quick.
I see some comments in here.
Yeah, a couple of the comments I've been responding to. So Mike Nuss has got a fantastic point that the reason rates went up a little bit last week is so many people are like, hey, let's dive in. For instance, one of my complexes, we just executed a refinance on Friday, 108 units. We got a 10-year term loan at 3.27%. It's pretty snazzy, right?
It's closed, done?
Well, it's got to record. So if we want to talk threats, there's rumor that the courthouse might be closed on Monday. And if the courthouse is closed, guess what? We didn't record. And that's unprecedented. So I don't know what happens there.
Got it.
Depends on when we open again.
Yeah. My apologies. Going back to Mike Nuss's point.
Oh, you're good. You're good. So yeah, Mike's point was that because so many people are seeing the opportunity and flooding in, that's when lenders, gave a little bump due to the competition of people looking for loans. So that's a fantastic point.
Yeah, real quick, because he only said it to all panelists, I'll just read the point. He says, Phil, I agree with the rates, but the quantitative easing across all financial instruments will keep loans going, which creates supply and downward pressure on spread. So that's what Phil is speaking to, that he agrees with that point. But you continued on, didn't you, Phil?
Did I?
Oh, no, you just said you agreed.
I blacked out.
Gotcha.
Mike's very smart, so I'm glad that he's on to provide some insight. Hell of an insight for owner financing deals. You need to have Mike back and talk owner financing.
Yeah.
Were you on that Go Abundance call?
No, I was not.
Oh my God, it was so sick. Go watch it.
All right.
But anyway, sorry, I'm trying to keep hold of the comments here. So Daryl had the $1 million question, and I think a couple others had hit on it as well, which is sort of the theme of this and what Nick just spoke to. It's the economic vacancy. And for those of you who maybe are a little newer or have never heard that term before, no judgment. So basically, I have a 100-unit apartment building, right? 10 of my units are unrenovated. That means that my occupancy is 90%. Easy math, right? But then I have another 10 who aren't paying their rent. So my economic occupancy is 80%. And it's actually worse to have somebody in your building who's not paying, because often they're using common area utilities, they're putting wear and tear on the building, so on and so forth. So I'd almost rather they just be vacant. We've had some other comments chime in about people, Ohio, they're in California and a few different places, they're shutting down bars, restaurants, service industry. Guess what? I'm a C-class multifamily guy. All of my people are working folks. And I'm projecting in the next couple of weeks, they're not going to be working. What does that mean for me? That's a huge threat. So I was chatting with somebody. Who was it?
Was it Daryl?
Earlier. Yeah. You know what? No, I'm sorry. It was outside of this thread. It was one of my partners, Jonathan. He's another guy who's got some smaller complexes like I still have, like Nick still has. What happens when a 20-unit complex, 10 of my people all of a sudden aren't paying rent? What are we going to do? That's the $1 million question. That's the threat. And without federal intervention, I don't have a great answer for you. I'll spit out a couple things that I'm thinking. Number one, get on the horn with your bank sooner rather than later. Open your books to them and say, what are we going to do about this? Like, bank, I'm content to pay you as much as I can, but I'm not in a position to lose however much a month. I'm thinking my one little 14-plex or 13-plex, the debt service is like $5,000 a month, and my total rent received is like $11,000 a month. So it's not that great of a deal as it is. At a 50% OpEx, operation expenses out of 11,000, what am I actually receiving every month? And we've been doing a little bit better than that. So maybe after all expenses are paid, I'm receiving $6,500 a month. So that's about right.
5,000 goes to debt. Yeah. 100
Yeah.
change your door.
So cash flow it ranges. If I got some vacancy or some non-payers or whatever, that skewed a little bit, but call it between, 500 to 2,500 a month is kind of like the range of this little property. So in the middle of that is 1,500. If I drop 2 units, all of a sudden I'm just making my debt service. If I drop 4 units, I'm writing a check for 1,500 a month. If I drop 6 units, half, which I think is realistic based on what we're seeing in the unprecedented nature of this crisis, I'm writing a check for $3,000 a month. I mean, can I swing it off of the income from my other buildings? I don't know what they're going to do. The 108, what if 54 of them quit paying?
Yeah.
And the 82, same thing over there. So I guess my short advice, and we can dive into this further, is talk to your bank, figure out what they're willing to do for you. Talk to your property manager, check legality. I'm planning on raiding the security deposit fund if we need to. Right?
Talk about that. What do you mean?
I don't even know if this is freaking legal. I got to believe it is.
Sure, but this is, hey, listen, real quick, before you go further, guys, this is what this is about. So, legality and all of that, like I know people might, you can't, we're just talking about potential mitigation strategies in a worst case scenario. So this is interesting, Phil, go for it.
So, we were talking about the difference between Nick and I. I'm more ask forgiveness than permission. So if it's a difference between defaulting on a loan and maybe doing something I'm not supposed to, like raiding my security deposits accounts, those security deposits are getting spent.
Well, if they're agreeing to it, Phil, that's definitely not.
They agree to it. Exactly. They're going to agree to it.
If you're just going and taking it out of an escrow account, then that's illegal.
Right. Exactly. No, I'm not just taking it and putting it in my pocket. Of course not.
But no, if they're agreeing to it, there's going to be no problem.
Okay, cool.
You're just going to have that they agreed, and it goes.
There we go. I mean, I want to find a way to work with people.
I think that's going to be huge, because just evicting them, there's people talking about it.
The sheriff's not going to become a victim, and the courts are going to be closed.
Yeah. So I think working with them, making sure that where their income's coming from. Some of my tenants are very handy, so I might use them to finish a renovation, give them a rent credit for that month. They owe less. There has been a lot of utility company points made that they're not going to do shutoffs. So one way is to not pay the water bill for an apartment building and let that rack up, because they won't shut the water off, right? But you can still have your mortgages paid. Then figure that out at the end. That's one of my plans as well.
That's another one of my plans, to mitigate expenses as long as we can. Braden just chimed in. What do you think about taxes coming up?
So Nick,
you can let a property go multiple years without paying taxes. So Nick, I'd say that would be the first thing to cut off.
Yeah, this is a good, Nick, this is a good segue. So, all right, we've talked about some strengths, weaknesses, opportunities. I think we've kind of framed it, and everybody kind of gets that. But the other part of this I want to talk about was strategies, right? We're starting to get into that. We've kind of naturally progressed there. But on the tax point, I saw that pop up. So, Nick, you specifically, you want to give a little background on your strategy around taxes?
Yeah.
Go for it.
So when my brother and I bought our first building, it was a 5-unit, kind of in a challenging area. We really didn't know what we were doing, and I got taken advantage of a little bit by a bank where I got a rate of 6.25%, and they escrowed all of my tax money. So my mortgage payment was $2,100 a month with my mortgage payment and taxes, and the building was bringing in $3,800. And one time, one of my bigger rent payments didn't come in, and I only collected $2,100. Hold on, sorry, it's Bernie Sanders is talking.
Then we better listen.
Yeah.
To know what to do, the opposite. Sorry.
No, that's good. Go ahead.
Turn the TV off. But so I didn't collect all of the rent that month, and I needed to make the payment. So I realized that the escrow payment that I was making of my taxes was something that I didn't want, but I didn't realize that you couldn't escrow. So after about 6 months of having that mortgage, I decided to refinance, which was the first time I even knew about the word, and not have an escrow payment. So from that day on, because the taxes are about 30% of my income for each property, I decided to not have escrow. And in a worst case scenario situation, I would not pay my taxes. I would just take a 30% hit. And the reason why I decided to do that, I was looking at numbers based off of the Great Depression. The stock market took a 50% hit. There was 25% unemployment, and the rental market took a 30% reduction in rent. It probably wasn't exactly that, but I read that when I was looking through this. So it's just a fact that I had. So that was my reason to never escrow. And now it's going to be very helpful moving forward. I think that always having money for CapEx and money for these types of situations, when they say you should have 6 months of your mortgage payments in a bank account, this is where that comes into play. And I think it's important to have cash to take advantage of opportunities and also just keep yourself afloat.
So to this question, that's a great, great point. To this question that we have from, it just says BRA, I'm guessing that's Braden or Brandon. There's only two possibilities in here. With taxes coming up due in May, do you think there is any opportunity to negotiate a property tax payment plan with the county? My tax bill is $44K per year, $22K due in May. What do you think? What do you both think on that? Is that like you mentioned, like just don't pay it, or do you
100% already no taxes will be paid this year?
Yeah, I just
already made that decision. I made that decision on Thursday. We took an account of all of our cash on hand, even personal money, because we all own the LLCs, but like we have to make sure that everything's okay and we're just not paying. What happens after the first year is you're going to have a penalty. And so there's going to be an initial 10%. I did research to figure this out. So you have the initial 10% penalty, and this is for Lehigh County where I am.
I was going to ask you, this is state by state, county by county.
It's county by county, I imagine.
Yeah.
But we have a 2% discount, then a period to pay the full tax. Then after that, there's a 10% penalty. It's due by the end of the year. Then after that, you basically have 2 years before the county on that tax year can take your property. So for 2020 taxes, you have till 2021 through 2022 into 2023 to pay this year. So you could actually skip a full year of taxes and just pay everything late and make money doing other things. Like, I mean, that's like 3 flips for 150,000.
Question for you, Nick. Does your lender have a covenant about staying current with taxes and insurance?
So they do a pull down.
Okay.
But the pull down would bring the information that they haven't been paid, but they're not going to find out during a pull down that I'm not paying my taxes. Like that conversation will happen prior to.
Yeah.
What's a pull down? Sorry.
They pull a title, like a basic title report.
I'm picturing something technological.
The taxes have been paid.
Gotcha.
And it's, but I'll have that conversation up front. At the end of the day, I have opportunities where I can kind of take loans out on some properties that we have equity on and pay the taxes if they give me that big of a deal. But those conversations will happen up front. And I'm currently planning that we can weather the storm. So,
okay. There's a question from Zach. Is the 2-year part of that also county specific to your knowledge?
I'm not sure of other counties. I just know the county that I'm in.
Okay. There's another question here. 6 to 9 of mortgages and expenses is the rule of thumb, correct? Phil, you replied to that. What was your thoughts on this?
Yeah, I mean, it depends on the asset. If it's something super, super ugly, it might not be enough. But I think if you're operating within those parameters, you're going to be pretty safe on most normal type transactions. Like ideal and the ugly a lot. You know, there's a joke there somewhere, guys. See if you can find it. Oh, hanging out with Jamie Gruber. There we go. There's the joke. No, I'm totally sidetracked.
6 to 9 months.
6 to 9 months. So if you're doing a massive reposition, like I've done buildings where we've emptied the whole thing out, and obviously a lot of expenses still remain, taxes, insurance, mortgage, and there's zero income. So for something like that, you're going to need more. But if you're buying, say, a 20-plex that's 95% occupied, and in your tour you find that there's not, much in the way of emergent repairs and no, obvious CapEx in the next 3 years, 6 months should be golden, So I'm going to use my attorney's favorite answer. It depends. it's a sliding scale of risk.
And Nick, you go 12 months, right?
So I hold anywhere between 6 to 9 at any. I'm currently prepping 2 years, so we might not be purchasing the stuff I want to purchase. I mean, I'll lose deposits, which I plan on closing regardless because they're still good deals and I like the properties. But I think where I differ from Phil, where Phil's more hands off in the sense of the day-to-day operations, and his job within real estate is more like capital and finding larger deals, and like that's very time consuming. So there's going to be, in this type of situation, I think if I have a roof leak or if I have a plumbing problem, I can go do it for very minimal costs, which is going to be busy and I'm not going to like it. And I don't like doing those things. I don't like putting floor down in our renovations all day long. But if that needs to happen, and that's why I think in Phil's position, he'll need more capital. But then there's also larger buildings, right? So there's more money to do that. So it just, the economy of scale brings different problems with different size portfolios. The one question that came in real early was, Jesse asked, do we see any investors panicking, becoming motivated sellers in the next few weeks?
Oh, I missed that. Yeah, thank you.
I think months. I think it's once May hits, and there's going to be investors that realize that they're going to potentially, kind of more to the unsophisticated investors that don't have access to capital, that aren't scaled, that have smaller properties, like the 1 to 2 building owners. They're going to realize that they need to tap into that equity, whatever they can right now, so that they don't lose the building. Because once they start missing payments, if they're not prepared, which not everyone's going to be prepared, not everyone has the ability to weather this storm, there's definitely going to be deals, but you're going to have to use hard money or your own cash. I'm probably going to go the hard money route because our cash is going to be there to sustain business and sustain operations.
Phil, what do you think so you and I think, disagreed a little bit earlier when we talked about the potential opportunity on the multifamily side. To the same point, like I just see as all of the people flooding the multifamily market now back off a little bit.
Yeah.
A lot of interest, right? I said, as they back off, sellers right now are fat and happy, getting 20, 30 offers on every property, right? Now they're not. They're coming up against a term. It's later in the year. Brokers are already, I've heard a lot of people say brokers are calling them and they've never gotten a call from this broker before. Like brokers are sounding a little desperate. So I see there being a buy opportunity within multifamily. I think you said you disagreed. Emphatically, I think was the word you used.
Yeah. I mean, yeah, I do.
So talk to
everyone with your 401k and that trade stocks, how are you feeling this week?
Yeah.
And I'm so annoyed with all these people that are posting on Facebook, like, oh, look at the market down. Give me your money for commercial real estate. But I mean,
wait, didn't Phil Capron have a post like that?
Sure didn't. I am, dude, you know what my stance on this. We're not getting into it tonight.
I do.
But this is very serious. And frankly, it pisses me off. A lot of the stuff that we're seeing out there, that is people claiming that they're going to be opportunistic and they're going to take advantage of this. Guys, yeah. This is not that. This is really bad.
Mm-hmm.
I hope you can sense the seriousness from my side and from Nick's as well.
Yeah. From an income standpoint, this is at least a month and a half. Even if it clears up if it clears up in 2 weeks, just Phil, take the point that it might, like, say there's a 1% chance.
Hang on. Better? Now you don't have to see me shaking my head.
Okay.
Go on, carry on.
Say 2 weeks passes and it's gone. Unbelievably unlikely. The tenants still missed 2 weeks of income. So there's a month and a half economic hit just from the decisions made to close schools for 2 weeks. All right, Phil, you can come back.
I had to mute myself too. Just going to talk right over you.
I want to see that mane. There it is. Yeah.
There we go. So, yeah, we know that more than half the country doesn't have $500 to deal with an emergency.
And this is that emergency for everyone.
For everyone. These are your tenants, Nick, your tenants, Jamie's, my tenants, and a lot of other people whose names I know that are on this call. This is real. Our friends that are big in the Airbnb space, it's a space I never really liked. They're getting absolutely brutalized.
We just canceled ours, right? I just literally canceled ours. We were going, the three of us and a couple others were going to New Orleans at the end of the month, and we just ghosted. We canceled it. We got our money back on it. So go ahead, Phil. Sorry.
They're getting absolutely destroyed. So I'm taking out there. I'm taking zero joy in the fact that maybe there's some people that are going to lose their buildings, because that
Yeah,
sucks
it
for me.
sucks.
It means that stuff's that's trading at a bad basis when I could borrow more, when I could build more. However, I think, Jamie, where we were getting to originally, where I disagree with you, is all these people that are getting destroyed in the stock market. If we do rebound to, say, I don't know, a 25,000 point Dow or something like that, they might say, I don't want this roller coaster anymore. I've worked for years. I'm 60, I'm 70, I'm 75. I just need my annuity. How do we do that? You give your money to someone like me, and I kick you out, 6, 7, 8, 10, whatever % dividend a year, and then we cycle it over a few years down the road. That's what they want. They want security. So I think, if anything, there's going to be more pressure put on commercial real estate. My caveat for that is, if we don't see smart tactical government intervention to make it so that the owners of restaurants, of new retail shops, of Nick can speak to, other vendors, apartment building owners, homeowners, if we make it so they don't lose their homes, that's in businesses and buildings, that's for the better for everyone. Yeah. Because when the restaurants can't pay, guess what? The building owner can't pay the bank. When my tenant can't pay, at a certain point, I can take it down to the point that I'm not making any money. I can write checks to a certain point, but if it goes beyond that, if it's allowed to go beyond that, what am I going to do? I can't, print money like the government can't. So, I think there needs to be intervention. And as long as that's done intelligently, so that we can kind of maintain the status quo, almost like put a pause button on what's going on. Like, I've talked about this, and, I probably sound like Bernie right now, but I think there needs to be a pause button put on all rents, all mortgages, all private debt, all credit cards, until we get through this.
All taxes?
All taxes.
No rent coming in.
That's what I'm saying. So if the renter, even if they're not making any income, if they don't have to pay rent, they have a roof over their head. If they don't have to pay credit card payments, they can keep food in the pantry. And I'm going to go a step further and say that, if the Fed's at 0 to 0.25% and the average credit card payment is 20%, that potentially we should be able to do something to get the consumer debt under control right now during this period. The banks and the uber wealthy are going to get the money back, because the reason they have it to begin with is because people make bad decisions. The reason why we have so many renters is because they never are going to make enough good decisions to own their own stuff, like Nick, Jamie, and I. So the relief has to start there. And then it kind of goes up the stream to Jamie, Nick, and I saying, if we're not receiving rent, we've got to put a pause on the debt we either owe to Freddie Mac, Fannie Mae, the local community bank, the private lender, to make sure we're not losing properties. And that utilities, if you're well-to-do and a patriot, pay your own utilities. And if you can't pay, those companies need to be sending the bills up to the federal government for payment during this time of national emergency. Then once we are back to work, we kind of have a ramp up that, the rent starts getting paid for a couple months, and then the mortgage starts getting paid a couple months after that. And the credit card rates that we slashed down to 6-7%, which is still killing compared to how much they get the money for, or the ability to lend the money for, ramps back up to market 20% or whatever, and we can continue on. If we get to a point where everyone's losing their businesses, their buildings, their homes, I don't know that we can come back from this.
Yeah. It's going to be tough. We're going to face something. I mean, there's no doubt about that. And to your point about, even for those that might be, there's the effect on these people, like these hourly employees. This sounds pretty dire. Like what Phil, both of you guys are talking about. But the thing to keep in mind is, like, imagine what somebody's thinking tonight that lives in one of our properties that doesn't know how they're going to feed themselves, their family, or whatever the case would be. It really is a bit scary in that regard. Hey, two quick things. So Mike Bug, mentioned about Italy suspending mortgage payments. Good question, Nick. I was wondering the same thing. Is that for everyone or just for owner occupants? So I'd be curious to hear, Mike, if you can drop a comment in there, who that is. And then Zach put a question here for you, Nick. Says you talked to, I think you mentioned this, but your plans to expand this year, he's had the same plans. Does this change that at all for you? Like you said, you're going to close on the stuff that might be in process, but do you look at 20 units as still realistic for you this year?
Yeah, one of the moves I have is selling a single family home that we're going to 1031. I was going to buy 9 units with it. I might just reduce that to 4 units and put all of it into a 4 unit. So that's definitely going to close and definitely going to go through as long as it sells. And if not, I'm out my earnest money deposit. So I would negotiate your EMDs lower. And I still plan on doing that. I'm going to definitely see what happens the next 2 months. I'm still going to continue marketing for properties to try and find those diamonds of investors that want to take a lower cash offer, but I will be using hard money to do that. It's not business as usual as how I would run our cash versus using other people's cash for the properties. I might look into some non-recourse stuff, even though I would still probably keep it just because I'm not buying properties that aren't deals. So there's still a lot of money out there where I think that you can still wholesale these properties. So I might not be buying at a garden style 10 unit complex at an 8 cap. That's something I probably won't be doing. I'll probably still stick to what I'm doing now, as far as an 11 cap, 10 cap, small multifamily, usually 4 to 10 units. So it's still the plan. It just kind of going to weather the storm. Definitely see what's going to happen the next 2 to 6 weeks.
All right, Jedi, you mentioned in here, Jedi Hill, is that the timeline you're looking at? I'm not exactly sure. It looks like there was a remnant of a sentence before that. If you could just drop in what you meant by that, we can get that question answered.
No, I got it. It was there was a minimum of 2 months missed rents for many of the people, and more likely 3 to 6 months from the sounds of it.
Oh, I see.
So that's, I think, a minimum. If it disappears in 2 weeks, we have a 2 month issue. But I think it's more of a 3 to 6 month problem. If they're going to pause mortgage payments, Bug just answered that.
Yeah.
Small firms and families, whatever that means. Yeah, I don't have a clue. So, I mean, if they're going to stop rent, they have to stop other things. There's not going to be very many people
that can weather that storm.
Well, and Nick, can you talk about, because to that question, can you talk about for a second, I don't think you brought this up yet, how you have sort of started to plan for who might not be paying, like how you're projecting that out? Yeah,
so we discussed on Friday everything we know about each tenant, how they make money, who has online businesses, who has the opportunity to work at home, who works in the warehouses that are going to supply these grocery stores that will remain open. And also, where does our Section 8 money come from? Who has SSI and disability income? Who has other opportunities? Who we know definitely has money in the bank from their applications? So we're mitigating our risk by knowing how much money is going to come in, kind of guaranteed, because they're paying tenants, they're truckers that are bringing goods into the grocery stores, right? So we know kind of that we're going to still be around the 60 to 70% collection of rent, luckily, right? And our rents are also lower. They're probably 85% to 90% of market value compared to competition. So if there's going to be a 10% rental decrease on the competition, we're still where they're at. So I'm confident that we'll be able to go through whatever comes, unless the banks close, and then I'm not really sure what's going to happen. Like if lending stops, which I don't think it can.
Hey, Mike Nuss, thanks for stopping in. If you don't mind just dropping a comment in here, if you're still there with what maybe your big takeaway was, I appreciate you coming in. Hey, Zach was talking about a 14 unit. Phil, you're engaging with him on that, whether he backs away from one that I think he said 14, or maybe I know it's 14.
It's freaking tough, man.
What do you say? What's your thoughts on backing out or negotiating the price down at this point?
I mean, guys, I've got 100 unit closing on Tuesday. And it's not subsidized like some of Nick's stuff. So, I mean, I don't think it's unrealistic to say that we might lose 30% of our income in the next 2-3 months. Fortunately, I've got, it's very well capitalized with CapEx budget, operating funds, flexibility with the lender, but I'm half tempted to go to the seller tomorrow and be like, yo, this is insane. I need a two month credit of rents or, I don't know, like,
Yeah.
would we really back out? I mean, I don't know. I don't think so. It's a great asset at a great price. And then here's another thing. I was talking to a very smart individual earlier today who's got a few things under contract. So this loops right into what Zach's saying.
You weren't talking to me about this.
No, I have other smart friends. That's, that's why I'm able to do what I do. I just network with people that are really smart, and I get to hang out with my little dog and,
that's me too.
Do what it is that I do. Yeah. Tell Chalupa I say hello, please.
I will.
Give him a scratch on the head. So he's like, should I just bail on these deals? And we had a really thoughtful conversation over about half an hour. There's a certain, scarcity based, line that you could take. That's okay. I better sit in cash. But what did the Fed just inject today? 700 billion, or tomorrow morning, 700 billion into the markets. Guess what? Your cash just became worth a little bit less. And they're going to continue to do that just like they did in 2008. It looks like. So if that's the case, you should have next to no cash if you're concerned about that, and only assets.
Mm-hmm.
But then the asset
not reproducing income, or else you're going to lose those assets.
Well,
here's like a huge catch-22.
He's gonna buy him cash.
Okay.
He makes you look aggressive, Nick. He's very conservative, very smart. Maybe I should bring him on to one of our pod calls.
For sure.
But yeah, I mean, it just sort of depends on what side of the fence you're sitting on. If you're sitting on the fence, you look one way and you're like, okay, I should have only assets because cash is starting to be really stupid. On the other side, you could say, well, if there's no intervention and the world burns, if I have all this cash, I can go pick up Phil's properties. I'm not sure which is right. I think there's certainly arguments to be made on both sides of the fence.
Yeah. Okay. I think there's going to be deals, but I don't think there's going to be, like, all the real estate investors right now are not going to lose their properties. No. It's just not going to happen. If there's government intervention, it's going to assist us. And although I might not agree with it, it might be a short-term fix that might weather the storm a little bit. One question that came up, are we communicating these issues with our tenants? I think that's a really good question. I'm waiting until the 6th of April.
Yeah.
There you go.
Yeah. I'm going to see what they do, and then I'm going to respond, because we have the knowledge. They might not even realize it yet. Like my SSI, my Section 8 people, those rents are coming in. So I'm definitely not giving them the option. So my other tenants that are working, that I know are working, that aren't losing their jobs, that don't have kids, are still paying their rent. Mm-hmm. So I'm not going to give them the option and then not get any rent and screw myself 1 month when I could have another month and figure stuff out from there.
Yeah, there was a point Braden made, and there was actually 2 points he made separately. One was he's a little bit afraid of like these eviction laws or like eviction suspensions. Like even his SSI people might be like, hey, I'm not paying. I don't need to, right? I'm going to use that money elsewhere. You can't evict me anyway. I don't know. I guess you just kind of trust the human nature to say I got to pay for where I live, especially if you're on an SSI or fixed payment. They just let's go. You have to. That's all you can do, right? I mean, there's not much of a strategy, not that I can think of anyway, to avoid that. Another point I just want to honor this real quick is that he mentioned, somebody else seconded it, maybe thirded it. Having a call like this every week, guys. We'll see. Maybe I can convince these guys to come on, or somebody else if they're not available. They both have busy lives, but it's not a bad idea. Like once a week, just jumping on and talking through. All right, what's new this week? What happened? Maybe we'll be crying by the end of one of these sessions. God forbid, but who knows? But yeah, definitely can do that. And hey, one Q&A came in. Yep. What investment class would be hit most from this coronavirus scare? This is from Subra. Is it A class, B class, C class? Can you explain if he's evaluating properties, how to have a safety factor in his calculations, in his returns? So which investment class, and any advice on analysis? Phil, I'll let you start with that since you're more on the multi side.
So, I made you a promise before we did this, Jamie, and I'm going to honor it. But I'm going to say that I have a problem with the wording of this. Coronavirus scare. It's not a scare.
Fair.
I'll leave that there. You do your own research.
No, it's fair. That's a fair point.
So to answer the question and honor the question, I'm going to say most likely it's going to be C. It's the people, the restaurant workers, the contractors that are forced home. A's and B's, they're working remotely. They're on Zoom like us.
Yeah, A is going to work remotely.
A is going to be okay. And then also below C, if you're working in subsidy, I think you'll probably be okay there.
Yeah.
B minus to C, I think is going to get crushed, which sucks because that's where I live. And that is traditionally the most recession and, world event resistant asset class, because there's always people working at restaurants. There's always people building the roads. There's always people cleaning out the hospitals and doing stuff like that. I'm not sure there's going to be in the next few months. And
Yeah.
I'm terrified.
This is something that I could not have even imagined. Like my tenants losing their ability to work, because it's easy to get a serving job, right? It's easy to go there and work. Like my one tenant is HUD and she's a server, and I know I'm not getting her $100 portion, but that's not what I'm necessarily worried about. Yeah. I'm worried about the other 12. Right?
Very jealous of you right now, Nick. I'm not going to lie.
Yeah.
Man, there's one building I have under contract right now. And this is tangenting something slightly different, but I think it's worth noting as a threat that's very closely aligned to the opportunity. I have a building under contract right now, and the numbers look phenomenal. It's a subsidy haven. I'd say maybe 70% subsidies. But the plan for this is to roll right into a Freddie Mac loan, because not a ton of CapEx and great rates, looking around maybe 3.6, 3.7 for the rate, 10 or 12 or maybe 15-year money. Like, sweet, right? 15. Government agencies and actually some smaller banks have a requirement that the property be 90% economically occupied for 90 days prior to closing. I think most buildings are going to have a hard time making that metric.
Economic occupancy,
in the next 4 to 6
point, right?
months. So if you think you got a deal and you got a sweet loan, you might be in for a rude awakening with, depending on the size of the asset, hundreds of thousands of dollars on the line. So be very careful when you're writing your contingencies if you are going to play in this very volatile space right now. I've been asked to submit an offer on 140 units, about 10 million. And, as of a couple of weeks ago, I was stoked to do it. I was looking forward to adding this one as soon as we close the other. Not so sure now. I'm not so sure. Like, if I can't get the loan at 3.5, 3.25, because this is a larger asset. If we're around 10 million, I'll have a loan proceed of around 7. So probably slightly more favorable than my 92 unit. I don't know. I just don't know.
Hey, quick question. There's a couple in here, but I want to, there's one about a trailer park. We'll see if we can swing that real quick. But before that, this question about hyperinflation. I think you guys both touched on this a little earlier, what you see coming. So let's take that question. Do you see hyperinflation happening? And just, if you haven't figured out the spectrum here, Nick is probably a little bit more okay, yeah, I see the downside, but he has more of an optimistic outlook on this. And Phil is feeling a little bit more pessimistic, or as he would say, realistic about it, right? So Phil's got a little bit more of a heavier feeling about the up, what's coming. So I want to ask the question, what are your thoughts on hyperinflation? And then from both of you, what do you guys see? I think we've all agreed that we see when this bounces, it bounces heavy, comes back hard. Agreed or no?
I think it's going to happen quickly when it bounces back, because bars can open and it's going to take 2 weeks for everything to kind of level out whenever that happens. As far as hyperinflation goes,
well, give me a timeline on that too. What do you honestly project? And I know that we don't know, nobody knows, but you guys are pretty smart guys. Do you see this as, we're not going to see the end of this for the rest of the year, or do you see this as a through the summer issue?
I'm hopeful that it's a 2 to 3 month issue. And then by July, everything's kind of back to normal. By August, markets bounce back. So April, May, June. So like 2 to 3 months, 3 months at the worst.
Phil? Feel further?
Yeah. I mean, this is...
I want everyone to buy guns.
I mean, you should have them. If you don't, then...
I agree with you there. Yeah.
I told Jamie we weren't going to go there, so we're not. But yeah, I mean, the supply lines, they're not cut, but they're damaged. There's some real stuff going on from the macro perspective. I mean, Saudi Arabia is using this opportunity to put a thorn in our side, which is total crap. I have an opinion on what we should do there as well. you know,
Talk
I
about
guess,
supply lines real quick. What of the China kind of coming back and all that good stuff? We'll get back to inflation. Sorry, guys, we've kind of gone a far
no,
field.
I tangent a lot. Let me do inflation really quick.
Yeah.
I don't think they're going to allow it to get into hyperland. I think inflation historically has been underreported. You know, you can feel it in the minimum wage. You can feel it in the price of a gallon of milk or a loaf of bread or whatever metric you want to use over the last 10, 20 years. They're saying it's, a couple percent a year. And when you look at common, household goods, it's higher. Are we going to hyper? I don't think so. I think that we've got, the right commander in chief to weather this storm from an economic perspective. And we'll just have to wait and see. But hyperinflation, the short answer for me is it's going to be no.
What about you, Nick?
Yeah, I agree. I don't think that it's going to get high. If it does, people are going to need to pay those prices in a way, right? So,
True.
Yeah.
I think there's just going to be. I don't think there's going to be a recession. I'm very optimistic, mainly because I just don't want to think about some parts of it. But I don't think it'll go. I think it'll stay 3 to 5, kind of where it's been. Kind of has to in a way.
Okay.
So I'm with you, Nick, in that it's very difficult to think about, but that's why I do.
I mean, dude, I have food in the basement from time to time.
I'm not talking about that. I'm just talking about handicapping risk from an economic perspective in our assets. I mean, planning.
I'm preparing. I'm
Good.
literally preparing.
Yeah.
I'm preparing for 2 years. So.
Yeah, I mean, if I had to give you an answer, I'd say that we're going to be dealing with the fallout from this time next year. But optimistically, I think we're turning the corner from the disease towards the end of the summer. And then we can have hopefully a reasonable Q3 and to close out the year in Q4. And then, it's so much of it rides on what kind of relief is granted, how widespread the disease is. I mean, the fact that you've got CNN and Fox News, pick your poison, I don't care. You probably watch one of them or at least consult one of them, are saying to prepare for hundreds of thousands of millions of deaths. Based on my ownership, I've got dead people in my building. I just don't know which ones yet. That really sucks to think about. And so again, I'm gonna kind of lash out at the people that have been Facebook warriors talking about how this is some great time. It's not.
Yeah, this is not how I wanted to think about taking advantage of opportunities.
Right. No, that's a great point. This is, right. Nobody projected this being that, hey, once something turns, this is how we're going to take advantage. This wasn't the way, not with, I mean, I went to a restaurant today just to kind of get myself prepped for the week, which I do every week. And there was like 8 people in there. It's a busy place normally. And it was dead. And the impact. A friend of mine owns or manages restaurants. He's like, my people are saying, I need hours. And I just can't give them to them. I can't give them hours.
And they're paying $2 an hour if they're servers.
Yeah. So it's unfortunate and it's scary for folks like that. I mean, again, I'm sure we will have worse stories to come for some of us as well. We'll feel hardship. We'll feel something here, and it is what it is. But I do think getting together in groups like this, I like the idea of doing something weekly. I'll think through that a little bit just to kind of continue to talk about and see what's going on and have this discussion. I think it helps everybody. But I heard a quote from a friend of mine, Jim, who might be on this call. He said to me, we should take the threat seriously, but we can't live our lives threatened. And I like that a lot. I think, taking it seriously is not cowardice. I think that's kind of out there as well, right? Like, you just go out, you do this. Yeah, but going out is getting people sick potentially, or I don't know. It's take the threat seriously, abide by the CDC stuff. Know that there are folks probably in worse and more dire straits than you are right now as a property owner. Just you got to weather the storm. So let me see here. If we could take this out and minimize damage, we see how much to come in a few months. Yeah. So I think there was another question there, but it's right at the bottom of the next hour. We're an hour in. I think we can.
I need to answer this mobile home question.
I'm sorry?
I have to answer this mobile home question because it's very exciting.
Oh, that's the one. Yeah, go for it. Let me hear it.
Well,
real quick, did he put it to everybody? He did. So, all right, everybody could see it.
I would close. I would then go on Facebook Marketplace and buy rundown mobile homes and get some guy to put it in there with a digger for $300, $400 and then just rent it out. You can get mobile homes on the internet, like deals for like $1,000. So that's what I would do.
That's true. And while we're wrapping up, guys, if you could just drop a key takeaway for them, it helps me too as well as we go through this. I got Darren Light throwing a takeaway in there. Thank you. Throw some takeaways in that you got from today. What's kind of an aha or something that you benefited from listening to these two guys, so we can continue to work on this if we do something, whether it's with them or other guys every week. But yeah, Phil, Nick, any kind of closing thoughts? Anything that you want to end with?
Yeah, one of the final comments was that someone was depressed about this, but I think that you need to be optimistic, be positive, and plan, right? Even if you're not optimistic, plan. Because if you're just going to go month to month, not thinking about how you're going to weather this, it's have the discussions early with people who you need to now. Like, I've already talked to my father, my mom, my wife. I know how my daughter's going to eat. I know how we're going to make payments. I know where we stand financially. So know where everyone stands financially, know where you stand financially, be truthful about that. Figure out what bills you can not pay to get your mortgage payments, have those conversations, and then have a plan, have a good plan, and talk to people that you respect their opinion, see what they're doing as well.
Love it. So great take.
These guys are already pouring in the comments, but I was going to suggest that as a value add to everyone that's on this call, let's be really deliberate about everything we think we can do. Mitigating expenses, mitigating vacancy, discussions with lenders, because that's where the rubber's meeting the roads for us guys, and it's meeting the road quick. So David just had a great comment. Proactive approach to loan payments, the various strategies that we discussed. Fill vacancies with government backed. The only pushback I got there is I'm not sure the government's going to be operating that in high capacity. They're already sending folks home, working remote, blah, blah, blah. So I'm ideally, yes. I just don't know that that's going to happen overnight. And again, Nick's point, just drive it home, plan. The tax thing, speak with your lenders up front, delay property taxes, communicate with your bank, create the game plan. There are any other expenses that we can really get away with not paying? I mean, utilities you mentioned.
Not paying bills. They're not going to turn it off.
It's a fair point.
What's that going to rack up? A couple $1,000?
It depends on the size of your complex.
Yeah, size of the portfolio. For me, it's a couple $1,000.
Okay, it's more expensive for me.
Yeah. Yeah. But I mean, they can't take your property.
They can't. But if
neither can the water bill. The water bill is lienable, but utility payments, like I might put them in like another LLC's name, like start an LLC and then put the utility payments in those names and then just bankrupt it.
Wow, that's aggressive. Here's something. How about if
real quick? That's actually an interesting strategy if it gets to that point, right?
I don't think that's going to be workable in a lot of circumstances. They either want the owner or somebody with a valid lease. In my area,
interesting. I didn't say it was the end all.
That LLC's renting the basement, bro.
All right, whatever. So let's go with it.
Who gives a
so something that's slightly more above board is if you are financially, have a good standing, and if you don't, bring someone in who does. Maybe carve off some equity for various projects if you truly are in dire straits.
Idea.
Go maybe get a $10, $25, $50,000 credit card on the building, and just understand that you're going to have to work like hell to pay it off. It's way better than missing mortgage payments.
Yeah.
If you do that,
minimum payments for a little while.
Yeah, your time in this business is short. Commercial lenders are lending on assets, but I mean, they take it real seriously if you're not meeting your obligations to other lenders. So don't let a short-term problem because of what's going on here impact your long-term trajectory in this business. Find a way. Partners, lenders, credit cards, deferring bills that aren't going to impact your credit or, make you lose the property. That's all I got. Did we miss anything?
I don't think so.
Okay.
This is good, guys. Honestly, I mean, there's a ton of takeaways here. I just kind of snagged them. And we'll talk. We'll see if this is something we can commit to for a couple of weeks and see if it's adding value. It sounds like it definitely did tonight. And so glad all of you jumped on. You know, if we do, I'll be more planful in advance. It won't be like a 4 hour in advance fire drill. We'll get this out a little earlier than later. But no, guys, hey, honestly, I appreciate it. I know you both got stuff to do. I appreciate you jumping on, and I mean, both of you are just, you know, brilliant guys. So thanks to both of you. I'll see you both tomorrow night. And thanks to everybody that joined tonight. Way better than Frozen 2. I guess that premiered on Disney Plus tonight.
That's good.
I was on Disney Plus
That's
tonight.
a high compliment.
Yeah, people are watching the Democratic debate right now, maybe, or they didn't to come to this.
That's why they're here.
Right. Yeah. That's a good
They
point.
want real advice.
That's a good point.
Wow.
Yeah. Yeah. But no, guys, I appreciate you jumping on. Appreciate you being here. And I'll put a replay out there. And yeah, have a great night. Stay safe. Abide by all the CDC warnings and everything. We'll be fine eventually, but definitely let's support each other through it. And guys, again, thanks for your time tonight.
Thanks, guys.
Take it easy.
We'll see you.